Good morning and welcome to Charting the Markets on Friday, the 3rd of February. US equity markets have been rampant of late after the US Fed's meeting on Wednesday, when Jerome Powell basically said that there was disinflation. And that's the first time he used that word in his comments, which led to equity markets rallying all over the globe. Now, we also had equity markets surge higher yesterday after the Bank of England and also the European Central Bank's widely expected 50 basis point rate hikes. But then they came off again slightly, still finishing positive territory. But this was on the back of disappointing earnings from the likes of tech giants such as Apple, Amazon, and Alphabet. Now, today's eyes are all riveted on the US non-farm payroll data, which is out at 1:30 p.m. UK time. And we expect payrolls in January to rise by 197,000 compared to 223,000 previously. And we also expect the unemployment rate to rise from 3.5% to 3.6%, and hourly earnings to rise by 0.3% month on month and 4.6% year on year. Now, this will be followed at 3 p.m. by the slightly less important US ISM non-manufacturing PMI data for January, where the index is expected to fall to 49 from 49.8. So let's have a look at what all of this could have as an impact on European and also US equity markets. And let's start off with the FTSE 100. And as you can see here on the daily chart, the FTSE 100 this year has been the great underperformer in Europe, having outperformed equity markets last year to a wide degree. But this year, you can see here, we are trying to head higher, but we're doing so very gradually. Heading back up again towards the January high at 7,876 in order to try to reach the May 2018 all-time high, slightly higher up. So not really much going on here with regards to the technical picture. Yes, we are forming a minor bottom here in an uptrend, which we've seen since December of last year. And as long as we stay above the last reaction low, that is to say, a candle's low, which is lower than the one to its left and to its right, and in this case, it's the end of January low at 7,708. As long as we stay above there, the uptrend is still very much intact. So let's move on to the German market. And here it's quite interesting because what we've seen yesterday is a surge higher to 15,553 on this daily financial bet. But then today we're actually coming off. And this is quite interesting because if you look from a purely technical perspective, what we can see here is the high made yesterday at 15,553 is higher than the high we made in mid-January at 15,272. Yet if you look at the bottom of my chart here on this daily chart, I've got my relative strength index, the RSI, and this is making a slightly lower high. So this is called negative divergence, when the market's making a higher high, yet the indicator is making a lower high. And that basically tells us that the uptrend is not as strong as we might think it is. And it is potentially pointing to at least a short-term consolidation back towards the late January high at 15,221, together with the mid-January high at 15,272. That's a possible downside target area short-term. And also the uptrend going back to the beginning of the year, which currently comes in between sort of around 15,152. So we may actually see a short-term retracement on the back of the US non-farm payroll data today. So we'll have to see whether that's the case or not. And as long as we don't take out yesterday's high at 15,553, the odds are really short-term that we will see some consolidation, or maybe some traders will take off some of their profits they made this year towards the end of the week. So we'll have to see. If we were to continue to rise and go above 15,553, then if you go onto a weekly chart, you can see here that we remain above this key previous support area, which became resistance in March 2022 and has now been broken through by the DAX between 15,059, 14,814. Basically, as long as that holds, we could still be heading up towards the high seen back in January of 2021 around 15,739. So that would be the next upside target if we were to continue to rise over the next few days. But as I said, we are seeing some negative divergence, which potentially points to at least short-term weakening being seen. And the technical picture is also very interesting in the US markets, because if you look at the S&P 500, what we can see here is that we are currently testing and briefly rallied above the September and December highs between 4,139 and 4,155 yesterday, but then closed back within that resistance area, and today in the overnight session so far coming off slightly in line with the European markets. So it'll be interesting to see whether today, Friday, which is also the end of the week, we can have a weekly close above 4,155, because if so, it would mean that we have a major bottom in place here, and that we could then head back up again towards the August side, 4,325. But we need to see a weekly close on this daily financial bed above 4,155, the September high, for us to go higher still. If we were to fail and close below that resistance area, it's quite possible that we might see some consolidation next week kick in. So we'll have to watch that pretty closely. Also, with regards to the Nasdaq 100, what is interesting here is that we have actually technically formed a bottom now, because we have risen and closed on a daily closing basis above the November and also the December highs between 12,258 and 12,084. And as long as we remain above there on a weekly closing basis today, on Friday, we will formed a weekly close above that resistance area and basically confirm this bottoming formation. And in that case, we could have an upside target take us all the way back up again towards the August highs at 13,722. So technically speaking, it looks as if the Nasdaq 100 has now bottomed out and is likely to push higher in the days and weeks ahead, even if short-term we might see a short-term retracement. This view will be valid as long as the 200-day moving average, as you can see here in red, and also the low seen this week at 11,817, 11,817 basically underpins. That's the last reaction low. So as long as we stay above there, everything's still looking quite positive with regards to the Nasdaq. The US dollar has started to actually rise after having fallen for several months and weeks and the last few days as well. Yesterday, on these worse than expected results out from the likes of Apple, Amazon, and Alphabet. And what is interesting here is if you look at the dollar basket on this daily chart, we did fall down to 101.57. And as you can see here, if I zoom out, that's a level last seen in April of 2022. But then we formed this bullish piercing pattern on the candlestick on the daily chart. So that in itself doesn't mean much, but I am paying attention to the dollar basket because, as you can see here, this low at 101.57 was not confirmed by a lower reading on the relative strength index. You can see here we have a higher low than the one we saw at the end of January, even though the index itself is making a lower low. And that is called positive divergence. And when that happens, there is a pretty good probability that at least a short-term retracement in the trend will be seen, in this case, to the upside, and that potentially also a big reversal may actually unfold. So for this to happen, what we need to first of all do is to break through the 2022 to 2023 downtrend line, which currently can be seen at 101.98. And then I want us to close above the last reaction high, which is this week's high at 102.26. But that would not really be enough. Ideally, what I also want to see for the US dollar to medium term continue to rise is to break through this resistance area made up of the December lows between 103.08 and 66. So interesting times ahead. We'll have to see whether we can break through all those different resistance levels in the next few days and weeks. And if so, we could actually see a reversal in regards to the US dollar basket. Now, the inverse of that is the euro dollar. As you can see here, the daily euro dollar chart is kind of interesting because here we've shot up to 110.33. and basically are now coming off there again. And the risk is that we are going to head back down again towards the uptrend, which was drawn in from the November lows, which currently can be seen at 108.10. And also below that, we've got a really, really good support area coming in between 107.66 and 107.15, made up of the December highs and also the mid-January lows. So again, here we could see a reversal simply because the latest high, 110.33 this week, was not confirmed by the relative strength index, which is slightly lower. You can't really see this on the chart than the previous high. So again, seeing negative divergence on this chart here. And we also see this on the Australian dollar versus US dollar chart, where here you can see that we made a high at 71.57 and then reversed down. And again, this high here has not been confirmed by the relative strength index, so showing us again negative divergence. So we basically have a theme here, because on the equity markets, we can see on some of the markets negative divergence. On the US dollar, we can see it with regards to dollar crosses, positive divergence, that is, for the dollar. And all of these signals might technically lead to a short-term reversal, because after all, we've seen some really positive momentum out of financial markets since the beginning of the year, and maybe now we will see that stall a little going forward. Commodity markets have also been affected by the strengthening dollar yesterday, and if we look at the price of Brent crude oil, first of all, what we can see here is that we have come off some really important resistance area earlier this week, and this was made up of the lows and highs seen since mid-October and basically the January high. And you can see here, every time we try to test that resistance area, we failed, and now we've fallen through the 2023, so the January to February uptrend line, and are trading back down towards the psychological $80 mark. So short term, it looks as if the price of Brent crude oil is continuing to head lower, because as you can see here, even from a medium term perspective, every time we try to bounce back, we fail at resistance and then we come off again. So here the downside target below $80 mark would be the low seen at the beginning of this year, around $75.65, and also the low seen back in December of last year at $75.32. Moving on to the price of gold, again very interesting, because from a technical perspective, once more we can see negative divergence here, meaning that we are forming, or we formed a new high, a multi-month high with regards to the price of gold, going back to levels last seen in April of 2022. And basically, we are coming off this $1,959 per troy ounce high, formed a bearish engulfing pattern, and are now testing the November to February uptrend line. And if we were to fall through the last reaction low, that is to say Tuesday's low at $1,901, then we would have formed a top here, a small top, and we could then slide all the way back down again towards $1,850 or so. So again here, negative divergence. Why? Because we made a new high, but it wasn't confirmed by the relative strength index, which made a lower high, showing negative divergence and pointing towards, at least short term, a consolidation or a reversal taking shape. Now, I'd like to finish up on nickel today, because nickel is actually holding up. It did also form a bearish engulfing pattern on Wednesday, and then yesterday did rally again. We have got this piercing pattern here on the candlestick chart, so potentially we could see further upside. So here the uptrend will remain technically intact as long as we stay above yesterday's low at $28,638 per metric ton. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.